What probability do you place on that risk of a US recession?
I'd say 60%.
Alexis Crow, welcome to the business.
Thanks so much for having me, Alicia.
US bond market investors appear to be pushing back against President Donald Trump's tax cut plan. Is that how you're reading it?
Well, you know the old adage, which is that, when I die, I want to come back as the bond market. And so I would say, Alicia, that the bond market has been truly the disciplining force when it comes to potential policy shifts and then backtracking within the administration. So I think what really, the debate surrounding the potential tax bill is yet another kind of piece in this new cadence that we've had of a brave new investing landscape, according to which the days of unidirectional, low volatility, placing your money in U.S. assets are likely to be over. And we're seeing diversification really be the name of the game. And so I would argue that the bond market and yields on the 10-year hitting 4.55% was one thing that potentially prompted the administration to backtrack some of its decisions on trade policy. And so, of course, that's on trade. And when we think about the fiscal deficit and the potential impact of a tax bill in amplifying the fiscal deficit, that's been one other force. And we've seen, obviously, with the recent downgrade from one of the ratings agencies joining the other two, and the impact that had on the bond markets of hitting the yield on the 30-year and above that psychological threshold at 5%. So on the whole, I think investors are asking to be paid more to be able to hold bonds, which are deemed to be of a new, different kind of risk premia.
Well, the supposedly safe haven US bonds are at the center of this market turmoil. How worrying is this?
Yeah, I think there's a lackluster sales that we've had. A couple of recent sales have been met with lackluster demand as well. At the end of the day, when we think about the longer-term implications on financial stability and potential shakeouts in financial markets, it's important to note from Treasury data in the order of either 24 to 30% of Treasuries are held by foreign holdings. And so that's not necessarily a super dramatic amount, so we're not necessarily concerned about a weaponization of foreign holdings. If we go back to the early parts of this quarter and we look at some of the sell-off, there's still some open questions as to whether or not that was hedge funds, as to who sold their Treasury holdings as well. Something else to think about is not only the status of the Treasury is in a position of question, but also the position of the dollar as a safe haven asset and just holding the dollar as a reserve currency. So we have seen notes from the ECB to various banks that they supervise across the Eurozone to potentially look at their exposure to dollar liquidity and any potential liquidity risks should a Fed not be able to provide the liquidity mechanism that has historically provided. So I think there is a reordering that's going on that's also reaching beyond the Treasury market and into currencies.
As you say, the European Central Bank has said the US policy uncertainty could shake confidence in the US dollar as the global reserve currency and US sovereign bonds as safe haven assets. What's the significance of this commentary?
I think it's more prudential, which is just to say, let's look at the potential risks that are on the table. And if as much as anywhere from a fifth to a third of funding is settled in dollars on behalf of some European lenders, you may have balance sheet mismatches. And historically, central banks have relied upon the Fed for swap lines or repurchasing agreements to be able to meet with demand for dollar liquidity in a time of stress and market volatility. And so I think it's more of a macro-prudential, just kind of pragmatic question, just to say to the banks, let's reassess and let's look at our business model just to be certain that if we have a situation where there's a need for dollars and the Fed can't provide it, that you won't be caught off guard.
US public debt is around 100% of GDP. Donald Trump's tax cut bill could worsen that debt load by up to $5 trillion US dollars. Why are markets so concerned by this?
Part of it's interesting to note that if you look at the Congressional Budget Office Outlook, which was released in March of 2025, they forecast that the ratcheting up of the fiscal deficit will actually be largely due to the increase in debt service costs. so really interest rate payments. So this kind of issue of the twin trade and fiscal deficits is an interesting one, because if you're using tariffs to try and reorder trade policy, that may also potentially impact inflation, which then you'd have to hold rates higher, so that it could create this kind of vicious circle to go back and then create and contribute to elevated households, not only household debt service costs, but also government debt service costs. So that's the situation that we're in, and I see it as very difficult to elude or escape that.
So the administration is essentially pushing up its own interest cost.
Potentially, and I think you have to also look, some of the statements from the Fed are saying we have to look at where the tariffs land. Something that we don't know, Alicia, is whether or not these will be, just say in the best case scenario, you have a baseline tariff of 10%, a little bit of an increase in other countries, or a lot, depending if it's China, 39% effective tariff rate. Will companies treat that as a one-off cost increase, or will they potentially use this as an opportunity to continue to increase costs? That's something that we just don't know. I think certain companies have evidenced that they are willing to try and regain pricing power over the consumer, and they're willing to pass this on. That's not what we've seen in the data from this first quarter. Largely what it shows in the US is that retailers and wholesalers have absorbed this initial kind of uncertainty, but we've seen retailers make it very clear that they're not necessarily going to continue that as we move on.
Well, bond yields are marching toward 5%. What is the bond market signaling about inflation, and what is your outlook?
Well, in the United States, we're in a position where we've had stickier inflation. If you even look at services inflation, that has remained relatively sticky as well. 1/3 of our CPI comes from the housing market, or shelter costs. So it's either owned or renters equivalent shelter costs writ large. Now, we have record high house prices in the United States, as you do in many geographies, not necessarily Australia at the moment, but many other geographies. And if you think about the exposure of the housing market, where we're chronically short of supply in the United States, to the tariffs that have already been implemented on steel, aluminum, Canada, our exposure to lumber flows coming from Canada, all of that leads to an elevated, stickier price environment. So whether or not you kind of move back and forth on the tariffs, I think the uncertainty is here to stay. So that's one, I think, important dynamic to point out. Stickier services inflation, an elevated cost of housing, and all of these will be difficult to address over time. I again also would point to this question of whether or not these tariff impacts would be a one-off. And I think, again, if you look downstream at some of the impacts on the automotive sector, for example, which is highly vulnerable to supply chain fragmentation and is not necessarily primed for onshoring, that you are looking at a higher inflationary environment. Something, Alicia, that we've also not talked about yet is immigration policy. And if you obviously look at the potential curtailments on immigration policy that started coming out with the initial executive orders, that could also push up wage costs in the United States in a meaningful and significant way, either by just creating and enhancing a labor shortage, or also by increasing the bargaining power for U.S. workers in lieu of foreign workers. And that, again, could contribute to a knock-on impact on inflation. And I would just highlight this is a situation, that is not necessarily shared by other economies. Obviously, we've had deflation in China for some time. Eurozone inflation has been comfortably coming down to be able to support rate cuts from the ECB. You've also seen inflation meaningfully coming down in the UK. So the US is really in its own unique position when it comes to other advanced economies here at having to combat a stickier than desirable inflationary environment.
So the US Federal Reserve is in a tough position. I mean, should the Fed be hiking to fight inflation, or will it need to cut and support growth and employment? Do you see rate cuts, and if so, how many?
Our forecast, you don't see cuts this year. We're in an environment, it's important to point out, we're in an environment where economic growth has not necessarily slowed super dramatically. Again, if we look at the latest print, negative net exports is meaningful, and that's something that's been called out by Jay Powell that the Fed will continue to monitor. What we're seeing with Fed participants across the board is you're seeing a very clear statement to be able to wait and see. We just don't know the impacts of what some of these initial tariffs will have on economic growth. And so there is very much a wait and see approach. I think it's definitely prudential not to cut in that environment, of course.
Well, it's fair to say the US administration's tariff policies have stoked economic and policy uncertainty. What is your forecast for US growth, and do you see a recession?
I think it's important to say absolutely the recession risk is on the table, but will it be severe and dramatic? And so obviously you can have 2 consecutive quarters of negative growth contributing to a technical recession. I think that's absolutely positive at the back end of this year as we continue to see demand deferral from households. Again, I think what's important to note here is how severe would it be? Would there be some shakeout in financial markets or a correction in asset prices, something happening within the credit market, such as the private credit market, that would exacerbate any kind of economic downturn? And that's what we'll be watching for. Again, a technical recession is kind of easy to navigate, but if you have the effect of any instability in financial markets compounding that, that's where you have a real issue.
Well, briefly, what probability do you place on that risk of a US recession?
I'd say 60%.
Okay, so not small. Dr. Alexis Crow, thank you.
Thanks so much for having me, Alicia.